Imagine a worldwide community of investors, not Wall Street tycoons, but teachers, engineers, and neighbors, all united by a shared set of sensible money principles. This is the world of the Bogleheads. Named after John Bogle, the founder of Vanguard and a tireless advocate for the individual investor, this philosophy centers on one powerful idea. Investing doesn't have to be complicated to be incredibly effective. The Boglehead mission is to help people help themselves. They champion low-cost, tax-efficient investing, and, perhaps most importantly, they promote a culture of rational thinking and personal support. The ultimate goal isn't to beat the market every year, but to build a secure financial future that allows you to sleep soundly at night and one day retire on your own terms. It's about replacing financial anxiety with confidence and control.
Chapter 1. Mastering Your Financial Behavior. Before we talk about where to invest, we must look at who we are as financial beings. Our financial habits are the foundation upon which everything else is built. Sadly, many people reach retirement age with little more than a Social Security check to their name. This isn't always due to a lack of income, but often a lack of the right knowledge and tools. Generally, people fall into one of three financial behavior categories. First, there are the borrowers. These individuals live on credit, purchasing what they want now and worrying about the consequences later. They live with an illusion of wealth while actually owning very little, trapped in a cycle of debt. Next, we have the consumers. They spend every dollar they earn. While this approach, live for today, leaves nothing for tomorrow, it makes the accumulation of real, lasting wealth nearly impossible. Finally, we have the keepers. Keepers aren't necessarily high earners, but they are masterful at understanding and growing their net worth. They are intentional with their spending, prioritize saving, and make their money work for them over the long term. The key insight here is to shift your focus from how much you make to how much you keep and sustain. To build a solid foundation for investing, you must first upgrade your financial mindset, pay off high-interest debt, and establish an emergency fund. This creates the stable launch pad from which your investment journey can begin. Chapter 2. Finding the money to invest. A common myth is that you need a lot of money to start investing. The truth is, you need to start investing to get a lot of money. The most powerful ingredient in this recipe is time. The earlier you begin, the more powerful the effect of compound growth becomes. Think of the rule of 72. It's a simple way to estimate how long it will take your investment to double. Just divide 72 by your expected annual rate of return. For example, at an 8% return, your money doubles every 9 years. This isn't magic, it's the mathematics of patience. So where do you find this money? There are two primary ways: earn more or spend less. The most powerful approach is to do both. Start by saving a percentage of your income, even if it's just 1%. Treat this savings like a non-negotiable bill, the most important one you pay to your future self. To free up more cash, become a conscious spender. Track your daily expenses, that coffee, that impulse buy, and you'll find countless opportunities to save. Consider getting a raise and investing the difference, buying second-hand, or even exploring a less expensive neighborhood to live in. The money is already flowing through your life. The goal is to channel some of it toward your future. Chapter 3. Your Investment Toolkit. The financial world offers a vast menu of investment options, but you don't need to order everything. The Boglehead approach favors a few simple, low-cost choices. The most common building blocks are stocks and bonds. When you buy a stock, you own a small piece of a company. When you buy a bond, you are essentially lending money to a company or government, which promises to pay you back with interest. Stocks offer higher growth potential, but come with higher risk and volatility. Bonds are generally more stable, but offer lower returns. Beyond these, you have pooled investment vehicles like mutual funds and exchange-traded funds, or ETFs. These allow you to buy a tiny piece of hundreds of different companies in a single transaction, providing instant diversification. For most investors, broad market index funds, a type of fund that simply tracks a large segment of the market, are the ideal choice because of their low costs and excellent diversification. A critical factor often overlooked is inflation, the silent thief that erodes your purchasing power over time. To combat this, you can consider government-backed inflation-protected bonds, which are designed to preserve your buying power, ensuring your money doesn't slowly become worthless. Chapter 4: The Pillars of Smart Investing. Knowing the tools is one thing. Knowing how to use them is another. The core of a successful strategy rests on three pillars: asset allocation, diversification, and cost control. Asset allocation is simply the decision of how you divide your money between different asset classes, like stocks and bonds. Your ideal allocation isn't a random number. It's a personal decision based on your financial goals, your time horizon, and crucially, your tolerance for risk. Money you need for a down payment in 2 years should not be invested the same way as money for retirement in 30 years. Diversification is your best defense against risk. It's the classic wisdom of not putting all your eggs in one basket. By spreading your investments across hundreds or thousands of companies and different types of assets, you ensure that a failure in any single one won't sink your entire portfolio. Finally, cost control is a superpower. Every dollar you pay in fees, commissions, and fund expenses is a dollar that isn't compounding for you. High costs are a major drag on returns over time. By choosing low-cost index funds, you keep more of your money working in your account, where it belongs. Chapter 5: Navigating Taxes and Maintaining Your Portfolio. Even the best investment strategy can be undermined by two certainties in life: death and taxes. While we can't avoid taxes entirely, we can be smart about them. Investments held for the long term typically benefit from lower capital gains tax rates. Using tax-advantaged accounts like IRAs and 401ks is one of the most effective ways to shield your growth from the taxman. Once your portfolio is set up, it isn't meant to be forgotten. It requires occasional maintenance, known as rebalancing. Over time, some investments will grow faster than others, causing your carefully planned asset allocation to drift. For example, a strong stock market might leave you with a higher percentage of stocks than you intended, and thus more risk. Rebalancing is the process of selling some of the outperforming assets and buying more of the underperforming ones to return to your original allocation. It's a disciplined way to buy low and sell high, and keep your risk level in check. You don't need to do this obsessively. A review once or twice a year is often sufficient. Becoming the architect of your own financial future. The Boglehead journey is about more than numbers on a screen. It's about taking ownership of your financial life. It teaches responsibility, forward thinking, and the profound value of starting now. The principles we've discussed: mastering your behavior, saving consistently, investing in a simple, diversified portfolio of low-cost funds, and managing taxes and risk are not a secret formula. They are a time-tested map to financial security. Remember, the most important investment you can make is in your own financial education. You are the architect of your own fortune. Don't be led astray by media hype or the illusion of complex strategies. The power to build the future you envision, whether that's a retirement on the beach or the peace of mind that comes with true financial independence, is already in your hands. It begins with a single, simple step. Well, we have reached the end of this book summary. Hopefully the discussion was useful and provided new insights for you. For those who found this content helpful, don't forget to like this video as a sign of appreciation, share it with friends or discussion groups who might need similar insights, and subscribe to this channel and turn on the notification bell. Because every like, share, and subscribe from you means a lot for the future development of this channel. Thank you very much for taking the time to listen until the end. That's all from me. See you in the next book summary video.